Hey everyone and welcome. Today we are diving into the world of stock splits. What are they? How do they affect you, the shareholder? And most importantly, why is that big drop you might see in your brokerage account not a reason to panic? A stock split is when a company increases the number of its outstanding shares. Think of it like cutting a pizza into more slices. You still have the same amount of pizza, but it's in smaller pieces. For example, in a 2-for-1 split, if you own 10 shares at $100 each, you'd now have 20 shares at $50 each. The total value of your investment remains the same. Companies typically split their stock to make it more affordable for smaller investors. A lower share price can attract more buyers, increasing the stock's liquidity, meaning it's easier to buy and sell. As a shareholder, a stock split doesn't change the fundamental value of your investment. You own more shares, but each share is worth less. It's really just a cosmetic change, not a financial one. You don't need to do anything. Your brokerage will automatically adjust your holdings. After a stock split, you'll likely see a significant percentage drop in the price per share in your brokerage account. This can be alarming, especially if it's, say, a 50% or even a 66% drop. But remember, this is expected and normal. Your overall investment value hasn't changed. Don't panic and sell. Just give it a little time for the market to adjust. Please remember, this video is for informational and educational purposes only and should not be considered financial advice. Investing in the stock market involves risk and you could lose money. Always consult with a qualified financial professional before making any investment decisions. Stock splits can seem confusing, but they're generally a positive sign. They make a stock more accessible and don't change the underlying value of your investment. So don't panic. Stay informed and keep investing. If you found this video helpful, please like and subscribe.